Welcome to the Money and Meaning Show with Jeff Bernier, a show dedicated to helping you gain the confidence and freedom to lead a life of personal significance and help you get your actions and resources in alignment with what matters most.
Well, hello and welcome to the Money and Meaning Show. I'm Jeff Bernier. Today we're stepping into a topic that hits close to home: war, energy, and the price of gasoline. Because while geopolitical conflict can feel distant, its impact shows up quickly, right at the pump. So we're going to frame this conversation through two thoughtful and highly credible voices. First, John Cochrane. John Cochrane is a senior fellow at the Hoover Institute. He's a former University of Chicago professor and one of the most respected macroeconomists and financial thinkers of our time. And secondly, Michael Cembalest. Mr. Cembalest is the chairman of market investment strategy at JPMorgan Asset Management, and he's known for his deep research and his data-rich annual energy reports. Together, their perspectives can help us answer a critical question. What actually happens to oil and ultimately gas prices when war breaks out? And how should investors think about it? Let's start with Cochrane's core insight. When war enters the picture, whether it's the Middle East, Eastern Europe, or another energy-producing region, it's not just a political event. It's a supply shock. Oil markets are global, so even if the U.S. isn't directly involved, disruptions anywhere ripple everywhere. Cochrane emphasizes a few mechanisms. First, supply disruptions or risk of disruption. Risk premiums get priced in immediately, and policy responses like sanctions or reserve releases. The result is oil prices spike, and shortly after, gasoline prices follow. Not because of randomness, but because energy is priced globally, and scarcity, whether real or perceived, gets priced in immediately. So now let's widen the lens a bit with Mr. Cembalest's work. His annual energy work makes something very clear. The global energy system is far more fragile and more complex than most people realize. A few of his takeaways are that fossil fuels still dominate global energy consumption. The transition to renewables is happening, but very slowly. Energy infrastructure is capital intensive and slow to change, and spare energy capacity in oil production is limited. All of this matters, because when a shock like war occurs, there isn't a quick fix. We can't just flip on a switch and create more supply. Cembalest's research reinforces a simple truth. The world still runs on oil, and when supplies tighten, prices must rise to ration demand. Now let's connect this to the broader economy. Higher oil prices don't just affect drivers. They ripple through everything. Transportation costs rise, manufacturing costs increase, airline tickets go up, food prices often follow. Energy is an input into almost every good and service, which is why economists like Cochrane emphasize that energy shocks can look a lot like inflation shocks. But he adds an important and often overlooked distinction. The United States today is far less vulnerable than it used to be. Thanks to the shale revolution and fracking, the U.S. is no longer heavily dependent on imported energy. In fact, higher oil prices don't just hurt, they also increase domestic income through energy production. That's a major structural shift. So while oil prices are still a headwind, Cochrane's view is clear. It's more likely a drag on growth than a direct cause of recession, unless something else goes wrong. And in Cochrane's view, that something else is key. Historically, the real damage hasn't come from the shock itself, but from how policymakers respond. Cochrane points back to the 1970s, where well-intentioned policies made things much worse. Subsidies to offset energy costs helped fuel broader inflation. Price caps created shortages in gas lines, and rationing distorted markets even further. And here's the core insight. Prices aren't the problem. They're the signal. Higher oil prices send a message. Use less, produce more, innovate faster. When policymakers suppress the signal through caps, subsidies, or artificial controls, they don't solve the problem. They extend it, which is why Cochrane warns the real risk isn't the war, at least in energy terms, it's the potential for a ham-handed policy responses. So here's where perspective matters. Moments like this can often trigger emotional responses, especially when you see what you're paying at the pump. Oil is going high forever. Inflation is back for good. Or markets can't handle this. But history suggests something different. Energy shocks are powerful, but often temporary and cyclical. Markets adjust. Supply responds, demand adapts, and prices normalize over time. Cembalest's long-term data shows that energy markets are volatile, but not permanently broken. And this is where balance matters. We stay informed, but we're not afraid. We stay invested, but not reactive. So let's zoom out. War creates real risk. Yes, energy shocks are painful and immediately, but history is full of these disruptions. Oil embargoes, Gulf conflicts, supply shocks across many decades. And yet, innovation, adaptation, and markets have consistently moved forward. This ties back to the broader idea we've talked about before. We don't ignore the risk. We also don't underestimate the system's ability to adjust. That's rational optimism. So what should investors actually do? Well, not much. A well-constructed portfolio already assumes that energy shocks will happen, that inflation will fluctuate, and that geopolitical risk is unavoidable. You don't need to predict oil prices. You need a portfolio that can absorb uncertainty. This means, and this will sound familiar, diversification, global exposure, and avoiding concentrated macro bets. Because trying to time oil or geopolitics, well, that's just speculating, not investing. So here's the takeaway. War impacts oil impacts gas, and gas impacts everything. But for the investors, the lesson isn't to react, it's to understand, to recognize how the system works without letting it derail your long-term plan. Because the world is uncertain. It always has been. And yet progress, innovation, and markets have continued to move forward. Uncertainty is permanent, but so is progress. The key is building a plan that can live with both. That's the balance, that's the perspective, and that's what allows us to stay grounded even when the headlines aren't. I hope you found this helpful. If you like the show, give us a rating. Check us out on your favorite streaming service if you'd like to check out past episodes. If you'd like to reach out to me, I can be reached by email at moneyandmeaning@tandemgrowth.com. Or if you'd like to learn more about us and our work, you can check us out at www.tandemgrowth.com as well. Thanks and have a great day.
Thank you for listening to the Money and Meaning Show with Jeff Bernier, a show dedicated to help you gain the confidence and freedom to lead a life of personal significance and help you get your actions and resources in alignment with what matters most. We would love to hear from you. If you have any questions or comments on the show, feel free to reach out to us at moneyandmeaning@tandemgrowth.com, or you can find us on the web at www.tandemgrowth.com. Jeff Bernier is the President and Chief Investment Officer at Tandem Growth Financial Advisors, LLC, an SEC-registered investment advisor. This show is a production of Tandem Growth Financial Advisors, LLC. All information discussed is general in nature, is provided for informational purposes only, and should not be construed as specific financial, legal, or tax advice. Listeners should consult an attorney or tax professional regarding their specific legal or tax situation. Listeners should not rely on the content of this podcast as the basis for any investment decisions. A professional advisor should be consulted and/or independent due diligence should be conducted before implementing anything discussed in this show. While information presented is believed to be factual and up-to-date, Tandem Growth Financial Advisors, LLC, does not guarantee its accuracy, and it should not be regarded as a complete analysis of the subjects discussed. Tandem Growth Financial Advisors, LLC, does not make any representations or warranties as to the accuracy, timeliness, suitability, completeness, or relevance of any information prepared by any unaffiliated third party, such as guests on the podcast, and takes no responsibility for the same.